On January 1st of 2018, the new tax law went into effect. The Republicans tout it as the best tax law ever, and the Democrats say people will die as a result of the law. As we know, politicians, to put it lightly, tend to exaggerate. So what is the truth? Who will get tax breaks and who will not? When will you see more money in your paycheck, if ever? In this short video, I'm going to review the new tax brackets against those that have been replaced. One thing to keep in mind is that the tax filing due by April 15, 2018 will not be based on the new law. If your situation in 2017 was similar to 2016, you should not be surprised by the results your tax filer finds in preparing your 2017 return. For many, that may not be the case in April of 2019. Tax planning in 2018 will be important for many, particularly those who live in states that have high state income tax rates or high real estate taxes. Let's take a look at the new brackets so we can get an idea of how you might be affected. Then we will look at a few items that have changed and some that have not. This slide shows the new and old tax brackets. When your last taxable dollar falls in one of these brackets, that is your marginal tax bracket. Your average tax will be lower than your marginal tax. In any planning you do, your goal is to have your last taxable dollar that you earn in the lowest tax bracket you can legally achieve. Every bracket is reduced except the 10% and the 35% brackets. The 10% bracket has about the same boundaries as before, while the 35% bracket expands upward, which means it will keep many taxpayers from getting into the highest tax bracket sooner than before. As you can see from the chart, tax rates have been lowered. The 15% rate is reduced to 12, the 25 to 22, the 28 to 24, the 33 to 32, and the 39.6% to 37%. The two columns on the left are for those who file as single, and the two on the right are for those who file married filing joint. The horizontal yellow lines on the chart represent the new tax bracket boundaries. Use those yellow lines in planning for 2018. Here is a partial list of tax changes for individuals for 2018. Again, it is not a complete list, but it does cover some of the biggest changes. First, the number of brackets stays the same at 7. With the standard deduction about doubling, more filers will be able to file without itemizing deductions on Schedule A. That will reduce preparation time. Whether your CPA will reduce his fee is unknown, but I wouldn't count on it. The elimination of personal deductions, which is $4,050 for each individual claimed on the 2017 tax form, will be offset by the doubling of the standard deduction. However, if you are claiming a large number of children, you could see an increased tax bill. State income tax and local tax deductions, including real estate taxes, are being capped at $10,000. That means fewer filers will be itemizing deductions on Schedule A. The mortgage deduction change affects those who refinance or purchase new homes in 2018 and beyond and have mortgages in excess of $750,000. If you closed on your property before December 15, 2017, your deduction limit remains at $1 million. If you send your kids to a private primary or private high school, you now have the ability to use some of the money you put away in 529 plans to offset these pre-college school expenses. This could be a double-edged sword, as it will mean reducing money that you originally targeted for college expenses. Use this opportunity wisely. Doubling the estate plan tax exemption to about $11 million for individuals and $22 million for couples means fewer taxpayers will be affected by taxes on their estates. Finally, the child tax credit has been increased to $2,000, and there is a new tax credit for non-child dependents, such as elderly parents. Here are 4 items that will not change. First, for a medical expense to be a deduction, it must be in excess of 7.5% of adjusted gross income, the same as in 2017. Adjusted gross income is the figure at the bottom of page 1 of the 1040 form. However, with the capping of state and local taxes as well as mortgage interest, this may be a moot point for many. The 7.5% floor is in effect for 2018 and 2019. It raises to 10% in 2020. Teachers will still be able to deduct supplies they purchase for their classes up to $250. This is an above-the-line deduction, so it is worth much more than a deduction on Schedule A. Profit from the sale of your personal residence up to $250,000 for singles and $500,000 for married couples remains tax exempt. For all the talk of tax simplification, you will not be able to file your taxes on the back of a postcard. Anyway, you wouldn't want all your personal tax information available to everyone who handles your mail. All your personal tax information on a postcard is something you do not want. Here are 2 changes that affect businesses. First, the tax on corporations is reduced from 35% to 21%. There is a very important difference between personal income taxes and corporate taxes. We individuals cannot pass on the taxes we pay. We eat them. Corporations can pass them on, and they do. To a corporation, a tax is a cost of doing business. They must cover that cost as well as all other costs before they make a profit. What each corporation does with the new lower tax remains to be seen. Corporations cannot afford to make too much money over any extended period of time. It quickly invites competition. There is an old saying that pigs get fat, hogs get slaughtered. No corporation wants to get slaughtered. For businesses that operate as sole proprietors, LLCs, or as a subchapter S, there is a 20% deduction before the profit is transferred to their personal return. It is not clear at this point that all such entities qualify for this deduction. If you fall into this category, seek professional help. You may want to change your business entity. Here are some important points. Tax returns for 2017 are the same as the tax returns you file for 2016, meaning that you're going to use the same rules. You will see an increase in take-home pay in early February. Individual tax changes sunset after 2025. You are going to need more help from a tax pro when you file your taxes in April of 2018. There are more changes than I have mentioned, but I have hit the highest ones and those that might affect you the most. Tax planning in 2018 is going to be very important. Contact me with questions either on my website or by email, or you can call me at one of the numbers listed on the screen. And now for the all-important disclaimer.